All right, so a quick review for today's lesson. Again, what you have in front of you, a couple images representing the entities that have the ability to issue bonds, starting with our federal government, not only going back to World War I and World War II times where they were trying to fund, the war efforts, but all the way up to today where the treasury bonds and treasury obligations are used to fund all sorts of government spending, but also funding the current deficit. And so, not necessarily a habit to get into, but when you don't have enough money to pay your bills, what some people do is borrow money. And that's what the government does. And that's how they're able to fill that deficit. States, you see here, the state of Georgia is issuing a general obligation bond for some type of capital project or maybe to refinance debt. And then corporations as well for large capital projects. We have to remember, too, the impact associated with this and what happens to a company financially when we choose to take on this type of debt. So in a bond like this, is just an example. Remember, a couple of things. We have our coupon rate, or what we refer to as our interest rate, which is a stated rate, in this case, which would be fixed over the length of the bond. We have the par value or the face value of the bond, so whatever the value was when it was issued, usually in round denominations. Usually see it in hundreds or thousands. And then a maturity date, which is basically when the bond has matured or when the bond is redeemable for its par or for its face value. Okay, so let's look at, all right, so how are we evaluating bonds as part of an overall investment portfolio? So the amount that an investor can expect to receive in income as they hold the bond is referred to as the coupon yield. So when we have an investment that is yielding a return, that means it's giving us something for what we put in. So those coupon rates are fixed when the government or company issues a bond. So in this example, we have a general obligation bond of 5%. That coupon rate, again, represents the yearly amount of interest that will be paid based on the face or par value of the security. And so we got some practice with that last class, thinking about simple interest, where every year I know I'm going to earn 5% on my $1,000 bond. So very simply, again, my coupon yield, if the coupon rate is 5% and my coupon payment is $50 a year, again, my face or my par value times my coupon rate gives me $50. So your yield in this case is the same as the coupon rate. It is yielding 5%. Now, that is true when the bond is issued or when the bond is first issued at face value. What we'll start to see here today, what changes, because we'll start to talk about how bonds are bought and sold, much like other investments in the market. So to understand current yield, so we have our coupon yield, which is our first method for analyzing bonds. Now we're going to take a look at our current yield. So again, remember, bonds can be bought and sold. So you do not have to buy a bond and hold on to it for its entirety. You can buy it and sell it the next day, the next month, the next year, 5, 10, 20 years. But if you buy a bond, you don't necessarily have to hold it to maturity. And so since people can buy and sell bonds like they buy and sell other goods, the price of the bonds will fluctuate. So there is a bond market where bonds are bought and sold, depending on what the current interest rate or what the current coupon rate is. And as we'll see here in some examples, what the current or the current interest or the current coupon rate for similar or other bonds. So the way in which we evaluate our current yield is we take our stated coupon rate, but then we also have to factor in the present price or the current bond price. And now we're not just looking at the value of the bond at face value, but we're actually looking at what the bond is being traded at currently in the market. And so we calculate that by dividing the coupon payment by the current market price of the bond. The calculations part in this is fairly simple, but it's more understanding the components of it as we go forward. So in this example, we have a coupon payment of $50. So remember, our coupon payment is always calculated off the face or the par value of our bond. So in this case, it would be $50. But what if, as we said, remember bonds can be bought and sold in the market, what if this bond was only currently being sold, or if it was priced in the market at $800? So this yield or this return is going to be a little bit different than our coupon yield. So what we do then is we take our $50, which is our coupon payment, and now we divide it by the current market price for the bond, which in this case is $800. That gives us a 6.25% current yield. So if I bought this bond right now and that coupon payment was fixed over the length of the bond and I was able to pay $800 for it, I could say that I'm getting a 6.25% return on my investment in this bond. You can see as from the example previously, that's a lot different than the coupon rate, which we saw was only $50 of that $1,000 face value, which was 5%. Now, what happens if, again, bonds can be bought and sold in the market? What happens if this bond is selling above par or selling at a premium? What happens to our current yield? Well, we know that the coupon doesn't change. We know we're still going to be making $50 every single year. And now I take that divided by the current price of the bond, and you can see my yield actually decreases by almost 2%. And so we can see the impact of what happens when these bonds are traded on the open market. Now, you're probably sitting here thinking, well, why would a bond be traded at a different price in the market? Or how can bonds be traded at different prices in the market? Well, if you remember back from our previous example, we talked about when bonds are issued, sometimes they have to be issued at a discount or a premium. And that's very similar to how they work in the open market. They have to be priced in the market at a discount or a premium, depending on what's going on in the market. So to summarize that, so as prices go down, our yield tends to go up because we know that our coupon rate is going to be fixed. I know in this example, I'm going to be earning 5% for the life of the bond. Prices go up, then the yield will go down. Buyers will tend to drive up some bond prices. All right, so let's look at a couple of examples. And so let's say you are an investor in this company and you own a bond that has a 5% rate of return or a coupon rate or your current yield. But new bonds are being issued that are otherwise similar, offer a coupon rate. And what do we mean by otherwise similar? Well, similar companies, similar risk level, similar industry. Generally speaking, the conditions for this bond are comparable. And so what is most likely to happen here? Well, is the old bond as desirable as the new bond? No, it is not, because it does not have as attractive of an interest rate. And so what is the investor who owns the old bond with a 5% return inclined to do? Well, they're going to be inclined to sell their bond because they know they can sell this one and go out and find one that has a higher return. What happens to the price of the old bond? The price for the old bond will go down because if I can get something for 8%, I can't sell a 5% bond at full price. And then what happens to the old bond's yield? The yield will actually go up because remember, the interest rate is the same, 5%, but now the price for that bond will be lower. Now let's flip that. And let's look at if you were an investor and you owned a bond that had an 8% return or a current yield of 8%. And now new bonds are issued and have a 5% coupon rate. So what is most likely to happen? We might be thinking maybe nothing will happen. So is the old bond as desirable as the new? Yes, in fact, it's actually more desirable. 8% is certainly more desirable than 5%. What is the investor who owns the old bond with an 8% return inclined to do? Well, oftentimes what they'll do is they'll hold on to it since it has a higher yield than the newly issued bonds. Why would you sell a bond at 8% and go ahead and buy a 5%? Again, we're looking at this as kind of an isolated situation where you might be only buying one bond. What happens to the price of the old bond? Well, since its yield is greater than the newly issued bond, investors will tend to buy it, thus driving the price up. And what happens to the old bond's yield? The old bond's yield will decrease. Okay. All right, so here's this chart, and after this, we'll take a quick break in the video before we move on to the next part. But so you see here, you currently hold a bond paying 5%, or the current yield is 5%. And so current yield for similar bonds. And so this is an expanded look at the examples that we just looked at. So if you have a stated coupon rate of 5%, but there's current bonds yielding 8%, are you going to buy, sell, or hold? This is for the current bond that you're paying. And then also looking at, will the price rise, fall, or stay the same? So in the first example, we took a look at if I have a bond that is paying a coupon or a current yield that is higher than mine, well, I'm very likely and very probable that I will sell my current bond, and then the prices will then fall. If it's a similar interest rate or the exact same interest rate, the yield is the same for the bonds, I'm likely to hold, and then the prices will probably stay the same. Now, here's the other example that we looked at. We have a significantly higher yield. I am more likely to sell, and then the prices will fall. But again, now what happens when the stated coupon rate is higher than what current bonds, current yields will offer? You buy, and then the prices will end up rising. Okay. All right. So now would be a good time to take a quick pause, and you can head to Google Classroom, and you can start working on the first page of that assignment. We're looking at a case study of a company that is issuing bonds. And it's kind of some practice with some of the things that you saw on the first part of the video. And then when you're done with that, you can come back and finish up the rest. All right, so one other way, and this will be the last way that we're going to look at measuring bonds as an investment in terms of a return, is something called the yield to maturity. And so now up until now, we've talked about the coupon rate, but then we've also talked about what is the bond currently yielding. Oftentimes what investors want to know is, what am I going to get out of this bond if I buy it today and I hold on to it for its entirety, 10, 20, 30 years? So one way to estimate the bond's rate of return is to calculate, again, its yield to maturity. This can be calculated when you assume that the person investing buys the bond at the current market price and holds it until it has reached full value. So in this example, let's going to say you're interested in buying a bond with the following details. You're going to buy a 10-year bond. It's $1,000 par or face value with a current price of $900 and a coupon of 5%. So right off the bat, we can see that there are probably other bonds out there that are paying a higher interest rate. So my bond is not priced at or above par value. So let's again think about the rate of return from buying the bond as its current market price and holding to maturity. We can also think about it as the average annual interest rate with your gain or loss earned from a bond. All right, so a couple of components when calculating yield to maturity. And the terminology is you should be familiar with at this point. It's just a matter of making sure that we're plugging in the correct numbers. So we need our coupon over our interest payment, we need our face value, we need the current market price, and we need the number of years to maturity. And so here's how our equation works, and we'll go through this quick example, and then you go back to that assignment on Google Classroom, and you'll have a couple of calculations to work through. And so, again, yield to maturity. So I take that coupon, or that interest payment, I take that percentage, multiply that by the face value. So that's going to give me 5% of 1,000, which would give me 50, right? And so that's going to be on top. Again, I have my face value, which is 1,000. I have my price, my current price, which is 900. And then I have the number of years to maturity, which is N. So when we're doing these calculations, it's probably easier to do it in parts. So do the top half or the bottom half first, and then come back, and then you'll end up with a ratio or a number. In this case, we end up with a number of 60 over 950. And so if we break that down from a percentage, we would see that this investment, this investment is yielding 6.32%. So if I hold on to this bond for its entirety, I can say with confidence that this bond would pay, I would get a 6.32% interest rate. All right, so that's it for the bond calculations. Again, head back to Google Classroom and that second page of the assignment. You've got another example on there, but then you've also got a couple of practice problems with yield to maturity.